Today's market action wasn't really about a broad wave of optimism. What investors were responding to was a growing belief that AI-driven earnings strength may still be powerful enough to offset rising geopolitical and inflation risks, at least for now. U.S. equities finished slightly higher today, with the S&P 500, NASDAQ, and Dow all posting modest gains. But underneath those headline numbers, the market looked far less stable than the indexes suggested. Bond yields moved sharply higher. Oil surged nearly 4%. The VIX also climbed even as stocks rallied. That combination matters, because when stocks rise alongside higher yields, higher oil prices, and higher volatility, it usually means investors are still buying growth, but they're becoming less comfortable with the macro backdrop supporting it. The biggest driver today was the renewed geopolitical tensions surrounding Iran and the Strait of Hormuz. Reports that U.S.-Iran negotiations had stalled pushed crude oil sharply higher, and markets immediately began reassessing what that could mean for inflation. The issue isn't simply that oil prices rose today. The deeper concern is that sustained energy inflation could complicate the soft landing narrative markets have become increasingly confident in over the past few weeks. Higher oil prices raise transportation costs, they pressure manufacturing margins, and eventually they can weigh on consumer spending. More importantly for markets, rising energy prices make it harder for the Federal Reserve to cut rates aggressively, and that's exactly why Treasury yields climbed today. Investors are slowly shifting away from the idea that policy easing is just around the corner. Instead, markets are beginning to price a world where growth remains resilient enough and inflation sticky enough to keep rates elevated longer than many expected earlier this year. But despite those pressures, capital continued flowing aggressively into AI-related leadership. Semiconductor stocks remained one of the strongest areas of the market. Qualcomm reached record highs, while Intel rallied on reports tied to a potential Apple chip partnership. Institutional money still appears deeply committed to the idea that AI infrastructure spending can continue supporting earnings growth even as the broader macro environment becomes more challenging. And that's become one of the defining narratives driving markets right now. The belief is that AI productivity gains, data center investment, and massive capital spending on compute infrastructure can effectively cushion the economy against slower global growth, higher financing costs, and even geopolitical stress. Whether that assumption ultimately holds is still an open question, but for now, markets continue rewarding companies most directly tied to that theme. At the same time, today's sector rotation revealed something important about institutional positioning. Technology and materials led the market higher. Energy stocks also rallied strongly alongside crude oil. Meanwhile, traditionally defensive sectors like consumer staples and healthcare lagged behind. That suggests investors are not yet positioning for a recessionary environment. But there's another layer underneath this. Even as investors chased growth exposure, they were also quietly buying protection. Volatility rose, gold moved higher, oil surged, Treasury yields climbed. So what we're seeing is a somewhat unusual market structure, risk-on behavior in equities combined with defensive macro hedging underneath it. In other words, investors still want exposure to AI-driven growth, but they're becoming less comfortable with the macro backdrop supporting it. The biggest risks building beneath the surface is concentration. Market breadth remains historically narrow. A relatively small group of mega-cap AI and semiconductor companies continues doing most of the lifting for the broader indexes. That creates fragility, because when leadership becomes highly concentrated, the market becomes increasingly dependent on continued earnings perfection from a small number of companies. If AI spending slows, if bond yields rise too aggressively, or if oil prices remain elevated long enough to pressure inflation expectations, the broader market may struggle to absorb that adjustment smoothly. There's also a financing risk that markets may not be fully appreciating yet. Many technology firms are funding massive AI expansion projects while financing costs remain elevated. That model works as long as future monetization justifies today's spending. But if capital costs stay high for longer, investors may begin scrutinizing AI returns more carefully. At the same time, some of the older structural stresses in the economy haven't disappeared. Commercial real estate pressure remains unresolved, regional banking vulnerabilities still exist beneath the surface, and credit conditions remain tighter than equity markets alone would suggest. So while headline equity performance still looks resilient, some of that strength may be increasingly liquidity-driven and concentrated rather than broadly supported across the economy. One interesting debate investors are wrestling with right now is whether markets are underestimating how sensitive AI valuations remain to interest rates and inflation. As long as earnings momentum stays strong, investors seem willing to tolerate higher yields and higher oil prices. But if inflation expectations begin rising more meaningfully, that balance could become harder to maintain. I'd be curious how you see this developing, especially whether you think the market is properly pricing these inflation and concentration risks. Looking ahead, the next major test will likely come from inflation data and consumer spending reports. Markets will be watching closely to see whether higher oil prices begin feeding into broader inflation expectations, and whether consumer demand remains resilient enough to support the soft landing narrative. The upcoming Trump-Xi meeting is another important variable. Any escalation around export controls, semiconductor restrictions, or trade tensions could directly affect the global AI supply chain that currently anchors so much investor optimism. And that's especially important because today's rally still appears heavily dependent on confidence in AI-led earnings resilience. The broader takeaway from today's market reaction is that investors remain highly confident in AI growth, but they're becoming less certain about the macro environment surrounding it. Rising oil prices, higher Treasury yields, narrow market breadth, and increasing volatility all suggest that fragility is quietly building beneath the surface of the rally. For now, institutional capital still appears willing to chase growth while hedging against inflation and geopolitical risk at the same time, but markets rarely move on a single narrative forever. If you enjoy this type of calm, analytical breakdown of global markets, consider subscribing. I publish regular briefings focused on the deeper forces shaping market behavior. And thank you for spending a few minutes here today. I appreciate you being part of the channel.